Welcome to Early Edge Club. This is an internal stock pitch shared by a member of our core community. Consider this as a window into how an experienced investor analyzes a business. The presenter and other core committee members may hold position in the stock discussed, and their views or position may change over time. Early Edge Club is built around a small microcap focused core community of about 10 investors. Each of them have over 5+ years of investing experience. If you would like to learn how we think about businesses and follow what we are building at Early Edge Club, you are welcome to join our WhatsApp community. And if you are an experienced investor, you can also express interest in being part of our core community. You'll find the link to both below. This content is shared purely for educational purpose to understand the business and the underlying thesis, and not a buy or a sell recommendation. So let's begin.
Thank you, Suraj. Once again, I would just like to highlight that the company that I'm sharing today will be discussing. It's a very exciting company, but again, do your own due diligence. This is only for educational purposes. I already own position in this company, so my views are going to be biased. So please do your own due diligence if you feel like you're interested in taking any position, and also consult your financial advisor before that. Very excited to share with you guys this company, Deep Industries. We're going to go into details about what this company does. Let me just go to the screener page first. And what I really like to start off with usually is looking at the history of the price movement of the company. That kind of gives you a perspective of how the company has done in the past, and also gives an indication of how it could potentially do in the future. And it also tells you a story of how the company has evolved, right? So if we go to, let me just minimize this. Yeah, if we go to, the max last 5-6 years, we see that the company has actually been on a growth path in general, at least from the stock price perspective, right? So that kind of gives you an indication. One thing to note is that this price is only from 2021, and there is a reason for that, and I'll get into that also. And if we go to the profit and loss for the company, we can actually see that from 2018 till 2025, one might think that the company has actually only barely doubled its revenues. And in fact, if we look closer, the revenues actually tapered from 2018 to 2021, and then something happened after 2021 where the company went into this growth path. And so we'll try to discover what that something is. And if you look at the margin profile again, something similar is visible. The margins decrease from 52% to about 42%, and then 36%. And then there has been a recovery from 36 to 40, 42%. And one thing that we'll want to try and identify is whether these margins are sustainable, are increase going forward, or are they going to go back to 36%. So I hope you guys are excited to learn more about this. There's a very exciting story, and that's something that I would like to share. So let's just dive right in then. At Deep Industries, what does the company do? Basically, the company operates in the oil and gas services space, right? And it basically provides, it's been operational since the early 1990s. In fact, I think it started in 1991. And these are some of the services that it provides: mobile gas compression packages, work over well and drilling rigs, dehydration and small gas processing plants. It also has production enhancement contracts and offshore accommodation barges. Now, I know some of you might be thinking, like, what do they even mean? So just bear with me for a moment. In order to understand this, actually, what we need to do is we really need to understand the whole, how the value chain of the oil and gas industry looks like. So if you look at the value chain, think of extracting the oil or gas for that matter. Typically, it's oil and gas, as you might already be aware. It's not available on the surface on land. You actually have to dig wells and be able to extract it, just like how you would extract water from. That's pretty much an example that you can think of. Obviously, it's not as easy. It's way more complex, but the overall combination is very similar, right? So the way it works is, if you were to find water, typically आप dig करेंगे, you'll go under the level, you'll dig a well, you'll put in some machine to pull out the water from the water table under the ground, and then you'll extract it, and then when it comes to the surface, it'll have sediments. Then you'll have to clean it up for consumption. Then you'll push it across for household consumption, and there the person is actually going to use the water in their taps. It actually works very similar if you were to understand the entire oil and gas journey on a very high level. So the oil and gas value chain actually looks very similar. You can divide it into these 5 key steps on a very broad level. First is basically to find it. And what we mean, we basically, the term used for that is exploration. Then once we have identified certain opportunities where there are reserve basins and where the gas or oil might exist, then you drill it and bring the oil or gas to the surface. And again, there's a lot of complex process, but I'm just trying to explain to you the whole value chain right now. Once it's brought to the surface, you prep it. So when it comes to the surface, it oftentimes is mixed with unwanted chemicals. There might be moisture in it. There might be other things which you want to filter out and basically clean it and also dehydrate it. So that process is called basically prepping it. And once you've prepped it, you want to move it to refineries, bigger places where it is stored. And the last step from there is basically is dispensed into these petrol pumps and CNG pumps, and from where the retail consumer consumes it. So on a very high level, these are some of the broader steps where the overall oil and gas industry can be classified in. So find it, drill it, prep it, move it, and process and sell it. Right. And so the first two steps that we look at, the find it and drill it, this is something called the upstream. I'm just giving you the nomenclature that is oftentimes used so that it's easier for us to understand. This part of the process is called the upstream process. Then prepping it is called the midstream process. And moving it and processing it, sorry, prep it and move it, that together is called a midstream, and processing it, selling it is called downstream process, right? So that's how the overall structure is laid out. And so where does deep industry fall into all of this? So I think that's the most important question. Once we understand this, we need to answer. Deep industry is actually falls somewhere between drilling it and prepping it. And let me just explain slightly more into what it actually does, right? If you understand, Deep Industries is a company which will not be holding any of your wells. They will not be the company who will be the owners of the oil or the gas which is produced, but they will be the people who will be actually helping you extract these oils, these gases, and bringing it onto the surface, cleaning it, removing the moisture, prepping it, and also helping you move it. So that's where Deep Industry kind of has an expertise. The whole business model is more like a charter for hire kind of a business model where they rent out their equipment and their expertise. And the companies who are into this production of oil and gas oftentimes use their services. So they are a service provider, and they are not necessarily someone who actually would own the reservoirs or the basins or even be the owners of the oil or the gas itself. I hope that kind of makes sense, right? And you might actually wonder why that is the case. So obviously you can operate in all of these segments, but what Deep Industries as a management, in a very strategic manner, they have decided to be part of a service industry. See, one thing that we need to understand is when it comes to finding it, the exploration phase of the whole process, it is extremely time consuming. It takes a lot of effort, it takes a lot of knowledge, and until you find a reservoir or a basin, a lot of capex is involved and a lot of due diligence, a lot of certifications, licenses, a lot of time and money is spent in order to identify places where you can actually explore and drill, right? And so you think of it like, if I were to have a parlance in the investing world, think of it like innovator drug companies, right? They oftentimes are spending a lot of money and time to identify what are the next innovative drugs that could be beneficial for the human consumption and for their health. But oftentimes, when they come up with an innovative drug, which takes a lot of time and capex, they don't often do the manufacturing of the drug. And that's what is oftentimes pretty much outsourced to these CDMO companies or CRMO companies who do all of this manufacturing for them. So it works very similar in a very similar manner. These companies who are into the exploration and production phase, which are E&P companies like ONGC, Keynes, and Vedanta, oftentimes they will identify these wells and they will bring on experts like Deep Industries to help them carry out the services, right? This is where Deep Industries falls into the picture. So with that understanding, let's just understand, what is it that Deep Industry exactly provides as their service within this whole value chain. So the first one is like a mobile gas compression package. No, it sounds very complex, but if we really understand it, it's actually very simple. Let's just break it down. Like, it's the mobile gas compression package, right? So mobile is one part of it, and what the second part of it is a gas compression, right? Like I said, that let's just understand. So oftentimes what happens is when certain wells, so when dig a well, oftentimes the whole pressure with which the oil or the gas comes out is pretty strong and good enough for them to bring it to the surface, even with a compressor. But it's quite easy. But when the well has been utilized for a fairly long time, After a point, there comes a point where these gases or these oils are not easy to bring to the surface, and this is where a gas compression system comes into the picture. Right, so Deep Industry actually owns. This is an example. This is how it looks like a gas compression system, and these are basically mounted on a trailer with wheels. So it's like a trailer, like this open trailer, and it has wheels over here, which you might not be able to see in this picture. And it's a very mobile kind of a system. So when the deployment from one place is done, when the whole project is complete in one location, they can actually transfer it to another location, another well, or another area where they have another contract due. Right. So this is one of the services that they provide. The second is well workover and drilling rigs. Now, this is exactly what this kind of a system looks like. Now, typically, when you think of I would imagine, at least for me, this was the picture that I had in my mind when you think of so you'll have some kind of a machine where there's a big crane which is mounted over here and they dig into the system, right, into the ground using this whole system. It goes deep into it. They keep just basically hitting the ground until they remove the mud from the ground, and they go keep going deeper while continuously making the complete hole stabilize so that it doesn't fall back. So it's a very complex thing, but I've explained it in a very simple manner. But in a nutshell, this is how it looks like. It's just a machine that is there with a crane mounted on top of it. Again, it's very mobile, so it can be transferred from one location to another. It's like a tower and a crane setup. And yeah, so once you have the well dug up, there's also a rig, small rig, which is part of the system itself, which is where the most of the work goes on. Right. The other thing that they also do is dehydration and mini gas processing plant. Now, again, we can break it into two, like dehydration is one thing, and then gas processing is the other aspect of it. So what really ends up happening is, like I said earlier, when the gas, or oftentimes gas specifically, when we bring it to the surface, it is mixed with moisture, and that's unwanted. It's not good for consumption. So it degrades the quality of the gas itself. So what you need to do is, as part of the prepping phase, you need to dehydrate it, or basically remove the moisture using a dehumidifier. So in a nutshell, it's a industrial size dehumidifier that strips out the moisture, right? And then there are certain few additional steps which are done in order to make sure that the once the moisture is removed, the gas is ready for consumption, and it meets the purity specs of for consumption itself. So that's the other aspect of service that they provide. And then there is also a production enhancement contract that they provide. This is something which is very relatively new. And here, what they provide is basically, in many of these wells, when companies like ONGC and Keynes and Vedanta, when they actually dig into there comes a point, like I said, about when they've done about 70 to 80% of the extraction, the cost of extracting the remaining 10 to 20% is far higher than for them to actually move on to the next well. So as a result of it, what they end up doing is, it becomes very difficult for them to continue doing the extraction, and they would either way, in most cases, leave the well and move on with remaining 10 to 20% oil or gas remaining in the basin, which goes unutilized, right? Many of these wells exist and many of these reservoirs exist. So where Deep Industries comes into the pictures, they take something called a production enhancement contract. So as the name would suggest, they would basically come and say, what, the remaining 20% is anyway written off as bad debt for you, and you don't expect anything coming out of it. Why don't you give this for us to manage? We have the know-how, we have the machinery. We will make sure that we extract the remaining 18, whatever, 15, 20% of whatever is left, the remaining, the gas or the oil, and we'll take a percentage of whatever we are able to extract. So it's a win-win situation for both, because Deep Industries get a higher margin because they're directly dealing with. So far, if you look at all the services, they are actually giving it for rental services. Basically, it's a rental service that they charter for hire kind of services. But here they are directly dealing with the product itself, where they get a higher margin. And plus, for even the E&P company like ONGC, it's a win-win for them because they had anyway written it off, and anything that they get out of it additional to what they had written off, it's actually a win-win for them. They are more than happy to for that. So this is one of the services that they provide us, production enhancement contract. And last service that we should be aware of is something called an offshore accommodation barge. Now, most of the other services that I mentioned above are all onshore, and this is a recent development that Deep Industries has moved into, which is offshore. right? And so what is this offshore accommodation barge? It basically looks something like this, what you can see in the picture. So what really happens is many a times, if you look at the offshore drilling or wells and oils, like if you look at Bombay High for that matter, typically it'll be like a working rig like this. I'll just show you a picture. This is how the rig looks like. There'll be like a working rig, working well over here, and there's one big deep well which is going over here, and this is the rig and the platform where they operate everything from. But what ends up happening is people who are working over here, they're about 150, 200 kilometers away from land. And they can't continue working 24 hours for 30 days or 90 days continuously. They also need some rest. But there is, on this kind of a platform, there is no place for them to rest. So what companies do is basically take something like this. This is more like a floating hotel. It has like cabins. I'm sorry, just one second. Yeah, so it has like cabins, kitchens, workshops, and even a helipad, a helicopter pad to make sure that employees can be. Sorry, just let me just. I think this should be fine for now. Yeah, so it has like cabins, kitchens, workshops, and even a helicopter pad for them to for the companies to ferry the employees to and fro from the rigs, from land to the rig and back. And basically, it serves like a place for them to rest, to rejuvenate, and go back to work like a typical shift would work. This gets attached to the workover well, which is operating on in the sea. And again, this is something which is rented out. Yeah, so largely these are all the services which Deep Industries is providing. There are certain more services which they have planned for in the future, and I'm going to talk about that just in a moment. But before that, I wanted to just give a perspective about what is the total addressable market looks like. And I'm going to cover those services in the future growth prospects of the company. Overall, if you look at the overall segment that Deep Industry operates in, the overall oil and field services sector is approximately about 15,000 crores in India. That this I'm talking about is 2024, and it is projected to grow to about 31,000 crores in by 2030. Sorry. So that's at a CAGR of about 12%, right? It's not a very huge market. And within that also, the kind of rental and charter services that they're very niche kind of services that they're providing, that accommodates to about 25 to 30% of this market, right? So 15,000 crore ka 25%, 20 to 25% is what we can assume. So that turns out to be around four to 4,500 crores. And even if you take it on a lower side, say 3 to 4,000 crores is what this market is. And this could double by 2030 to about 8 to 9,000 crores. And then there is also a gas compression on charter hire. So if you look at the services that I mentioned, one second. The mobile gas compression package. This actually is the bread and butter for the business for Deep Industries, right? This has been the driving force behind companies' revenues for a long time, and now they have been adding services slowly and steadily. And this itself, this is one of the major, they actually have about 80 odd percent, 80 to 90% market share in in the oil and gas services space for gas compression packages, right? So even that actually, if we were to look at, it's actually valued at around 1,400 crores. And this 1,400 crore actually includes the onshore and offshore, but Deep Industries largely operates only on offshore, sorry, onshore. So if we were to total this together, just on a conservative side also, I've taken a target market of about 4,000 to 4,500 crores. That's the kind of TAM we are looking at for Deep Industries in the current scenario. Slightly more than this, but by and large. So we can say that it's not a very big market. It's a reasonably sized fish in a small pond. I wouldn't say it's a very large fish, but it's a reasonably sized fish in a small pond. And what we are looking at, if Deep Industries were to grow the way I see it, obviously they need to also grow into an offshore kind of a business where certain challenges exist, but also they are venturing into that. But also they can grow their geographies and expand their TAM altogether. So that's not something that we have talked about because they operate only in India as of now. So that's how the whole TAM is looking at. Let's look at the company history and timeline for now. I'll come back to the moat very quickly after that. Like I said, the company actually started in 1991. Various things which happened throughout their journey. They actually got registered in 2006 on BSE and NSE. And there were two key events that I wanted to talk about throughout their journey. One was the demerger that happened within the company. So company actually was earlier it was also known as Deep Industries, but there were two divisions within this company. One was the exploration and production, the upstream kind business that I was talking about. The second business is the services business that they currently do, right? So what the company actually used to do was, in this exploration and production business, they were actually making huge losses, whereas the services business was doing really well. And the company realized that because of the losses that they're going through in the E&P business, the whole valuation that they were getting for the services business was very suppressed, and they were not really, it was not incurring the kind of revenues that you should be getting. So basically, they demerged the company to do value unlocking. And what ended up happening was, this company was, they got their approval for demerger in 2017, and it was initially named as Deep CH4 Limited. And in 2018, they changed the name to Deep Industries, while the parent company was still listed on the stock market as Deep Industries. And when this Deep CH4 got listed in 2020, basically it was renamed as Deep Industries by then. So, in order to avoid confusion, the parent company, which was Deep Industries earlier, basically the E&P business, they renamed it to Deep Energy and Resources, Deep Energy Resources. And this company retained the name as Deep Industries. So that's how their demerger. It's very, I don't know why they went with a very complex, not a complex, but like they could have just simplified it further. But anyway, so this is how the demerger took place. It was a bit confusing for me to understand who was Deep Industries and Deep Energy first. But this is how we stand. Deep Energy is still listed on the stock market right now. It's not really doing that well, primarily because of the kind of services that they're providing. They still continue to struggle with it. And then there was another key event that happened for the company, which was they did a couple of acquisitions very recently, one in 2023 and then one in 2025. They basically acquired Dolphin Offshore Shipping, which is also a listed entity. This became basically bankrupt, and it was going through an NCLT auction. And Deep Industries they paid for it, whatever they bid for it, and they got through at a very reasonable, very cheap valuation. And they got hold of Deep Offshore Shipping and, sorry, Dolphin Offshore Shipping. And the other company that they also acquired was very recently called Kandla Chemicals. So both of these companies they actually got for a total of about 10 crores, right? So Kandla Chemicals was about 2 crore token and 8 crores for Dolphin Offshore. I think their bidding costs were much lower, but eventually when they ended up paying for all the equity, they ended up, the overall cost that it costed them was about 8 crores for Dolphin Offshore. And so put together, these two companies, Dolphin Offshore and Kandla Chemicals, got about 10 crores of cost for the company. And with that, they actually got a few assets along with it. So with Dolphin Offshore, they got this accommodation barge that I talked about, the video that the photograph that I showed with you earlier. And they also got certain certifications and the operation and maintenance crew, the marine crew that came along. They also got a couple of other vessels, small vessels, which is still not operational yet. And obviously, they also got like the track record for the company for bidding for various projects and the way they worked with the other E&P players in the past. Their contacts and their everything, their whole history, they got transferred to them. So that was Dolphin Offshore, and then Kandla Chemicals. It's basically a glycol blending plant, and it's Kandla Chemical and Energy is the company that they acquired, and they acquired the plant, the whole plant, and they also got the licenses and legacy trade receivables. Interesting that the company was acquired for 2 crores, but the company actually had receivables of 208 crores. So while you might think of it as that's great deal, right? But when the company actually tried to acquire and get after the people who the companies that were due to pay the money back, most of them either shut shop or they ran away. And what the companies basically Deep Industries has said is that they don't expect a lot of money of this 200 crore to come back to them, although they're trying their best to recover as much money as possible. But what they've done is basically written this off as bad debt. And so that's one thing that is visible over here. So if you go to the profit and loss, I'm just digressing from the overall timeline for a moment. But if you look at the profit and loss in March 2025, we see that there's an exceptional item of 258 crores. This includes this 208 crores of bad debt, that receivables that was considered as bad debt for the company, and another 40 odd crore from Dolphin Offshore for certain things that they had to write off. Sorry, from Kandla itself, Kandla company itself. I think their plant itself needs to be refurbished, and certain other 40 odd crores from that area also were written off. That was another key thing that we should be aware of. Yeah, these are the two things that happened. Now, if we go back to the profit and loss, like if you look at it, it's very visible over here. 2018 is when actually the company started, they divided the financials from, they separated the financials as they got the approval for the demerger, separated the financials from the parent company to the new company. And since that's why we see the details from 2018, but actually it got listed in 2021 on the stock market. So that's why you see the pricing chart from 2021. So that's something that we should be aware of as well. The other thing that also happened is, okay, I'll just talk about why this dipped when we come to the profit and loss analysis itself. So let's look at so we've gone through all these aspects, acquisitions we've covered. Yeah, and one more thing that I wanted to mention over here is that I talked about this accommodation barge that they acquired. So while the company actually acquired Dolphin Offshore for about 8 crores, this barge, which was non-functional, also came along with it. And now they've actually, in this year itself, in this first quarter, they've gotten a contract for this Prabha barge for a 3-year period for 281 crores. And the beauty of this, it's a very interesting thing. The beauty of this contract is this 281 crores is almost 90% of that actually translates directly into the EBITDA, because the operation and maintenance they don't have to do, and that cost they don't have to bear. That's the kind of contract they've managed to sign with this Mexico-based company. And it's a very interesting. So every year, about 90 odd crores is going to translate onto their EBITDA directly for the next 3 years at least. And what they did spend is about 110 odd crores to refurbish this barge so that it could be made operational once again. But even then, I think it's a great investment from the company and very smart play. Just by investing about 100 odd crores, you've actually made sure that you've got this barge which will last for another 10 to 15 years, getting about 90 odd crores on a yearly basis. So that was one of the very interesting things that happened. I thought it would be very interesting for us to know as well. So what are some of the modes for Deep Industry? Various things actually. So Deep Industries actually has one of the key things is that some of the contracts that they take on. Let me first talk about that. Typically, these contracts are long tenure in nature. The contracts that they get usually last from 3 to 5 years on an average. Some cases it also goes to 7 years. One of the recent contracts that they got for project, one of the recent contracts for a production enhancement contract with ONGC, they signed for 14 years, right? So I'm going to talk about that in the order book as well. But that's one of the key modes that the company has. And the other added advantage to that is they all these contracts actually also come with escalation clauses. So what that means is every 6 months to 3 months, something depending on the contract, they will actually look at the labor cost, the diesel cost, or whatever the raw material that is required to keep functioning. They will actually, if there's an increase in those costs, they actually got these also actually get passed on to the clients. Then there's also a high customer switching cost, because see, if you typically understand, like I said, E&P companies, they take a long time to find a well, and there's a lot of cost that goes into this. And when there's a production which actually begins, they don't want to stop the production at all, because it can, once you stop the production, if you want to switch an operator, it takes several days to switch an operator. And then it also takes, you need to go back and get the safety clearances, you need to go back and get the licenses. So it not just several days, it actually translates into a few months. And no company wants to have production switched off for several days to a few months. And that's why there's a very high customer stickiness with the Deep Industry. So once they get a contract, even if that means they have to renew it for, even if it means it's a 3-year period, but the contract actually might get extended, it does get extended with Deep Industries as well. And the other thing is they've never given any reason for any companies to get basically to switch Deep Industries as well, because they've had a very high proven track record of 99% uptime with safety for at least the last 10 years. And while the company offers 98% plus, they've been able to maintain 99% plus uptime in every contract that they've been able to work with. So this gives them a very good, I mean, it gives them a scoring edge when it comes to technical commercial tenders. It also gives comfort for the companies that they pitch in, because they know who they're dealing with, and they also have a very good comfort when it comes to Deep Industries. They also have a regulatory and licensing mode. As I mentioned, that when you operate in these kind of projects, you require a lot of clearances, you require a lot of licenses and environmental clearances. So many places they already have many of these licenses, they already have these processes, they already have their everything set up. So even if they don't have a license in particular location, they know how to get it. They have the know-how to be able to get it very quickly. And that's one of the mode that they have. And one of the other things that they're also able to do is provide an end-to-end service bundle. I haven't talked about some of the future projects that they're doing, but since they have since they operate into multiple services within this value chain, they are able to provide a complete end-to-end kind of a service for the customers. which actually provides them an added edge against most of their competitors, because they are not able to, some of the competitors are able to provide some of the services that they're able to do, but they are not able to match the complete end-to-end services that Deep Industry is able to provide. So that gives them a complete edge over some of their competitors. And these are some of the other, there are other subtle but powerful propositions that Deep Industry is also able to, I won't call them as moat, but definitely an added advantage for the company that they're able to bring in. Since they also have these assets which are very redeployable. As I said, most of them are mounted on mobile platforms, or either through trailers or either through whatever case, they actually get redeployed very quickly. And these are long-term contracts, oftentimes backed with LCs. They also get a favorable costing when they want to go for a capex with or a loan with any of the NBFCs. They get a very low cost as compared to most of their competitors because of the size of their operation. And they also have a tender history advantage. Like I said, they've had decades of experience and satisfactory performance. So companies already know who they're dealing with, and they automatically qualify through their pricing, at least the first level qualification. They don't have to do all the resharing of, they're already existing as a vendor code into the system of most of the companies. And there are not too many of these ENP companies. So once you get in, and obviously they also have the specialized know-how by now, because they have been operating for about 3 decades, a lot more than some of the other companies. Yeah, so these are some of the moats. I would want to very quickly just talk about, I think, let me just very quickly look at what are the other. Yeah, so let's look at the management as well. These are the key management personnel for the company. The company is operated by a very sound management. Two brothers, Paras Savla and Rupesh Savla, they're brothers, and they have been managing the team for a long time. 30 plus years have they have experience in this domain. Very well experienced management. They know what they're doing and what they need to do to keep the company going ahead. They also have other key executive management positions. Rohan Shah, who is the chief financial officer. This is the other person. He also has good credentials. Manoj Thakkar, who is the chief operating officer, and Ajay Srivastav, who is the vice president of operations, and he's ex ONGC. Again, knows exactly what needs to be done, has the experience to back up and work with the company. Management remuneration also is very reasonable. It is not anything that should be as a flag for Deep Industries. Yeah, and before I move into the fundamentals, I would like to just quickly touch base on some of the future businesses that the company is also planning to offer. It'll be very easy for us to understand now that we've understood the business altogether, right? So one of the key things that company is looking for, these are some of the future services that they want to provide. And basically it's combining some of their existing services and putting it all together. So that's charter hire for gas processing facility. So what they're planning to do over here is basically provide like a overall plant for gas compression, gas dehydration, and making sure that they boost the pressure and pass it on when they go downstream. They're able to have the right pressure, they clean it, maintain it, and everything they do for the company. They, like it said over here, they design, supply, install, commission, operate, and maintain all of the whole plant. So everything from extracting the gas. So you identify an opportunity as a ENP company, you identify that you've dug the well. So now the time is there for you to bring the gas onto the surface. So basically Deep Industries will come into the picture and they'll offer this everything. You don't need to worry about it. They'll bring all of their capital, all their machinery and everything, and all the manpower, also skilled manpower, and they'll extract the gas, bring it to the surface, clean it, process it, and put it downstream for the refineries to take it ahead from there. And why this is advantageous, and again, so it operates and maintains the whole setup for a daily rental fee. So one thing that you might wonder is why companies don't want to do it themselves and why even involve Deep Industries over here. So there are a lot of advantages for companies over here. See, sometimes what happens is some of these wells don't really have enough, should I say, the reserves or the basin is not that big, and the well actually might just last for 3 years, 4 years. But in order to set up this kind of to put in the capex and put in the money for this kind of a setup, it actually often costs more, upwards of 100 crores. And after 3 years, 4 years, they are unable to utilize if the well dries up, or if there's some sort of an issue with the license that they had from the government, or if the project finishes early, then companies don't know what to do with this kind of a setup, and they basically are left, this is like a dead asset for them, and it's a waste of their capex, right? By hiring Deep Industries, what they're able to get is also, okay, the other fact is also, when you're setting it up. See, an ENP company needs to set up a plant like this. You need to have a lot of technical know-how, and to do it right, also you need to be able to source different machines from different vendors and put it all together. It's a bit of a hassle. And then you need to get licenses, you need to get people to operate it. So a lot of things which are a lot of moving parts are involved, and people and the companies which are in E&P don't want to get their hands dirty in doing all of this work. And also it takes time to set up, right? Once you start the process, it takes about 12 to 18 months to set up. But with Deep Industries, what they're able to get is basically like a virtually zero capex, because they just pay a daily rental for setting up everything. And then Deep Industries is also able to set it up in 3 to 4 months because they have everything pre-built, and it's a skid mounted setup like I discussed earlier. They also provide the crew to operate the whole machinery with technical know-how. And they also guarantee that it's going to operate at 98% plus. But oftentimes it's more than 99%, in fact. They also bring in all the licenses, compliance. They already have the checklist and everything in place. So they can actually bring the licenses to operate everything. The machines are well maintained, and it is also approved by when you get to the site. So everything is done and dusted. You don't really need to bother about it. And it's a win-win for both the companies, right? So this is one of the places where Deep Industries actually sees as a future growth aspect prospect for the company, where the margins are going to be higher. Think of it more like a contractor. When you hire a contractor to get the painting job done or housework done, it is a hassle-free job, even though you pay slightly higher for a contractor, but you don't need to worry about taking care of everything. And contractor also gets a slightly higher fee. So the same thing works for Deep Industries. The machines are their own, everything is of their own. They already have everything in place. They just get a higher margin for doing this for the company. And the best part is, like I said, 3, 4 years may if the well dries up, all they need to do is just pack up everything and just take it to another location and start with another plant wherever the well is. That's how this business model works. And this is something that they're looking for in the future as well. And the other future service that they've ventured into is the offshore services. I'm sorry. So I mentioned they're mostly operational in the onshore business on land, but now they've also, with the acquisition of Dolphin Offshore, they've also ventured into the offshore services. They're just dipping their toes into the water right now with offshore services. So company has not really mentioned a lot, but again, with whatever they have gone ahead with, when we look at the Prabha Barge, the kind of fee and the kind of margins that they're able to operate is far higher than what they are currently able to operate with. And then there is also integrated project management services. This is again very similar to this the gas service that I was talking about, charter hire for gas processing facility. But this is more for drilling and for mining stuff. It's a turnkey solution to drill and complete a well. So it's again very similar to that. They'll again provide all these kind of machinery and take it to the site, and you don't even need to worry about everything. They will be able to start with right from the time that you get a go ahead. They will bring in the machinery and start digging the well and make it operational, keep it operational, and do the operation and maintenance as well. So these are some of the services that they provide under this kind of service. I'm not going to go into too much into details. This is available in the presentation. I think the call might just get slightly longer. Last but not the least, the another future growth aspect of what they're banking on is the production enhancement contract. I already mentioned about this slightly earlier. This is again something that is high EBITDA accretive for the company because, like I said, it's a win-win for both the company and as well as the E&P, and they get higher margins. Currently, they have a PC contract with ONGC for a tenure of 15 years. It's about 1,500 crores, 1,450 odd crores is what they get from ONGC. And the company has actually mentioned that since we have the liberty to do it faster, it basically boils down to utilization and production. So they are pretty confident that they will be able to get this kind of a revenue in about 10 years' time. It doesn't have to last for 15 years. Yeah, this is another area which the company is looking at as a prospect for future growth for the company. Yeah, let me just come to the financials. Yeah. So let's just look at some of the financials of the company. So from here to here, as we can see, like I mentioned, what ended up happening was there was a demerger that was taking place. So there was some cost attributed to that, but also the company started facing a few of the headwinds in terms of the services that they were providing. If you would remember, this was right around the time there was fracking happening in US, and prices started dropping significantly. Saudi Arabia said that we're not going to reduce our production. So there was a lot of offloading from Saudi Arabia, and the prices of crude oil started going down. And so the number of E&P contracts were decreasing. And that was one of the factors over here. The second factor was obviously there was a bit of a demerger taking place and there was an additional cost to it. The third factor over here, one thing which was very critical that happened was right around this time, there was a case which happened between ONGC and Deep Industries, where ONGC basically blacklisted Deep Industries from applying for any future projects for the period of 2 years. Now, this is very critical for us to know as investors. But Deep Industries basically, without going too much into detail, I'm going to touch base upon that and the risks part. Deep Industries basically said this is wrongfully, you blacklisted us, and whatever claims that you're having, it's not appropriate, and we have not done what you're saying we have done. And they counter filed a lawsuit against ONGC, which they happened to win in the lower courts, which ONGC then counterfiled it in High Court, which again was the verdict of the case was given in favor of Deep Industries. In fact, ONGC was also asked to pay a compensation for Deep Industries for the loss of revenue because they blacklisted Deep Industries, and which ONGC also again challenged, and the case went to Supreme Court, and now the case is going on in Supreme Court. But what happened in the interim was ONGC agreed that okay, fine, whatever happened, bygones, let bygones be bygones. This case might go on, but at least in the future projects, let's just continue working together. And that's how the history has been, just to touch base on that. So for these 2 3 years, because of COVID also, they didn't really get too many new projects, and there was a bit of a tailwind, and then they were also blacklisted, and all of that got affected, and the revenue decreased over here. Margins also decreased because the revenues itself decreased, so utilization dropped, and as a result of that, the margins dropped. And they also during these times added new services. So initially they were into only gas compression packages, mobile gas compression packages, which kind of gets you about 40 to 50%, upwards of 50% margins. But as they added the work well over ridges, those kind of services have a much lower margin. And as a result of that, also margins decreased over here. So over here, the tide changed with, as the COVID kind of started receding, new contracts came out, and they since then have been on a recovery path, and they've actually been growing. We'll actually get to the order book and also look at how sustainable the growth is also in the future. And even in the margins, so they've grown their margins from 36 to 42% over here. And in fact, let's just go into the detail over here where the company, there was a very interesting question that somebody had asked the management in a con call itself, like in terms of the margins. So what the company is actually guided for is that management is saying that the top line growth is going to be minimum of 25 to 30% year on year for the next 2 years at least, because they actually have an order book of close to 3,000 crores. This is how their order book has actually grown. So if you look at FY22, their order book has grown from 600 odd crores to about 3,000 crores, and it is very stable at as of now. And obviously, there are some open bids that the company is also participating in this year. So it might actually further increase. But that's for us to look forward and see how it works out. But what the management basically said that they expect 25 to at least on a 25% on a conservative level, and even it could touch 30%. And the profits are also going to be in the same range. And with respect to EBITDA margins, the management basically said that they are expecting to see further increase in their EBITDA margins from 42% to about 44% in the next 2 years. And yeah, and so how sustainable are these margins? Basically, one aspect of it is that one of the risks that company faces is the crude oil prices, right? So whether if the crude oil prices drop, are these margins going to be sustainable? And to which the management basically said, we actually worked on a fixed price nature, and these contracts oftentimes have very limited impact because of the crude oil prices. And even if they go up or low, like I explained earlier, if the costs increase or decrease, they are able to pass it on to their clients. And as a result of which the management saying is it does not impact. But at the same time, I personally, this is my personal belief that there is a counter thesis to this whole crude oil price impact. So while it does not directly impact the margins of the company, but if the crude oil prices drop, then the number of companies taking up the E&P contracts or even giving out contracts or drilling wells and bringing oil onto the surface is going to decrease further. And so there will definitely be some sort of a material impact indirectly onto the number of projects which they can bid on. So there is, while the management says there is no impact, I think they are not really immune to these crude oil pricing fluctuations for sure. But at the same time, like if you look at the kind of services that they provide, like this is the list of all the services. I just put them together. All the management does not explicitly say you'll have to comb through all these things through their multiple con calls before. So their gas compression system, which I talked about 40 to 45% of the revenue, and it's a very high margin profile. And this will continue to have growth potential. although they have about 80-90% of their market share in, at least on the onshore basis. Company says that they want to continue expanding this, and this is basically the bread and butter. So rigs and workover wells, this actually comes to about 20-30% of the revenue, and also the margins are not that high compared to some of the other services that they're providing. Right. So project management, this is a mix of gas processing and gas dehydration, again 20-35%, again with varying margins. And growth is going to be moderate in this kind of a segment. When it comes to production enhancement contracts, they are expecting a very high growth potential in this, and I'll talk about that in a short moment, why they are saying that. This is again going to be a high margin. In most cases, the companies basically said that it can be upwards of 50%, but at least 40% on a conservative basis that the company can actually see. Over here, like I said, they already have a contract with ONGC for 1,400 odd crores. This year, the management has said 70 to 80 crores of that business is going to be translating into revenue for FY27, sorry, FY26. Sorry, FY27, it's going to be 150 crores, and this would scale up for FY28 to 200 odd crores. Like I said, the company wants to complete this project in about 10 years. So even if you divide it by 10, you get about 150 odd crores per year, right? So this is high margin, high growth potential. And offshore services like Dolphin Offshore, again, it currently contributes very small amount to the overall margin, overall revenue, but this is very high margin, and also there's high growth potential also. Right, so this is how it looks like, and so this gives you an understanding of whether or not the margins can sustain. It basically tells me that the company is focusing on these kind of areas going forward, and this indicates that the margins have a good chance to improve. Not to mention the fact that they have acquired Kandla Chemicals, which actually manufactures the chemicals. The rationale for the company to acquire this was basically the kind of chemicals, the glycols that they manufacture. These are used in production enhancement contracts for drying of the well and certain other services. And so by making sure that they are able to use the chemicals that they are able to manufacture, they can further reduce their costs by about 200 basis points is what the management mentioned. So margins can then therefore also improve by 2%. But this is not going to happen immediately. The plant is only going to be active by FY27. So you will see this impact in FY28, not in the next 2 years. So what are some of the big growth drivers? We already have a big order in hand. There's a strong order book. They're looking at production enhancement contracts. I've already mentioned about that. Barge, the accommodation barge, we've already talked about that, 90 odd crores every year that they are going to be expecting onto their profit and loss. Kandla Chemicals, I already mentioned about how some of their chemicals are actually going to be used in the PEC contracts, and this can actually impact their margins by about 2%, but only in FY28 or so once the plant starts. Right now, the plant is not completely operational. In fact, it has not been operational for the last 3 years. So there is a lot of repair, and the company expects about 30 to 40 odd crores to be spent gradually for the repair of this plant. Also, there is a policy tailwind, and from the government point of view, there are two key policies that we should be tracking. One is the DSF 4 and the OALP policy that the government is having. So these both are basically tailwinds for the company. And what these are basically is OALP stands for the Open Acreage License Policy. Without going into too much details, basically what this allows companies to do is these E&P companies can just go and say that, you know what, these are the basins that we want to further explore. And earlier, this was a very complicated process. You had to submit your bids, and then they would ask for multiple companies to go and bid for it. And then somebody might get it, somebody might not get it. But now the government has actually eased up this process. The whole reason being that the government wants to reduce the dependency on oil exports. They want to make sure that they increase the consumption or the production of oil within the country, oil and gas both within the country. Whatever wells that they have, whatever opportunities that they have, they want to make sure that the E&P companies are able to explore those even more. And this is one of the policies that they've come up with, basically saying that if company wants to go and explore certain areas, you have more or less a free will, a free hand, that you will obviously get it much faster approvals to go and do that as opposed to what it was before. So this is going to drive more E&P companies to explore more reserves and basins around in and around the Indian territory in yeah. So the other thing is the Discovered Small Fields Policy, which is DSF, which I mentioned about that. So here, basically, what the government is saying is, earlier, like I said, many of these wells which were extracted, 70 or 80% of that would be used, and then many of these would leave with certain small amounts left behind, which are not produced or left behind because the production cost did not really justify the amount that they were getting. So now the government is saying that anybody who wants to go and bid for these wells and do these extractions, basically it refers back to the PEC contracts that I was referring to, right? They are pretty much allowing these new entrants or any other company who wants to go and explore these wells further and get whatever is left of those wells to extract that as well at a very lucrative prices with the government. It's a revenue sharing kind of a model with the government. So all this boils down to is more and more companies are going to operate these wells, and obviously it leads to more PEC contracts for deep industries. Yeah, so I think let me just see if yeah, I've not covered the competition. I'm just going to talk about the competition. I'm going to talk about the risks, and then we'll look at valuations, and then I think we can conclude the discussion over here. The competition, so in the listed space, there is no mirror competitor for deep industries. There are a few companies which are competing. I've just listed down some of the competing companies which are there. So Dolphin Offshore, obviously they've acquired, so it's a subsidiary of Deep Industries. Jindal Drilling is another one, but actually most of these operate in the offshore space, and the Deep Industries largely operates in the onshore space. And that's what segregates. That's one of the key segregating factor for Deep Industries amongst all of the other competitors. The other key factor is Deep Industries operates in charter for hire kind of services. So they don't actually do everything. They don't really go and they actually provide the machinery for the well to be functional. And that's what sets them apart as compared to most of the other competitors which are there in the listed space. There are a few which are in the unlisted space, but I think I forgot to mention the names over here. Yeah, but they're even then, even so, they're pretty small compared to the scale of Deep Industries. The only comparable somewhat is going to be Akash Exploration. They also provide similar services. They provide workover well services, compression and production support, something similar to what Deep Industry is able to provide. But again, their scale is also extremely small. Their market cap itself is about 100 odd crores, where Deep Industries is around 3,500 crores. Yeah, and even if you look at by the virtue of the scale of the operations that Akash Exploration has, they don't enjoy the kind of pricing power that they have. They don't enjoy the kind of margins that Deep Industry is able to get. Those are some of the other factors also to look at when it comes to some of their competitors. So very quickly, Jindal Drilling is into offshore, but they're also into drilling, but in a different kind of drilling. They specialize into specifically adjacency drilling without getting into too much technicals. Even Offshore, that's also into drilling services, again into offshore business. Sealand Exploration, this is more an E&P kind of provider. It is not into any gas production gas or charter for hire kind of a business, or even work or well ridges or anything. It's basically an E&P operator, very similar to ONGC or Keynes for that matter. Asian Energy Services, they deal into geophysical and seismic assessments and surveys. So it's a very different business from Deep Industries. Duke Offshore, they are able to provide most of this crew and people for operating these barges and vessels and even platforms, skilled manpower, and also they provide parts for replacement and management of maintenance and operations of the rigs and those things. So again, not completely, nowhere even close to what Deep Industries does. So most of these competitors actually don't operate in this space. This is where Deep Industries is set apart, and what they have also been able to do is just broaden their services that they're able to provide. And yeah, that's how they stack up against their competitors. So when it comes to valuations, I'm just going to open the valuation sheet. I think I was talking about the P&L. I think I covered the P&L from the balance sheet perspective. Very quickly, I'll just refer to this. I think I missed out on this aspect. Company has a very strong balance sheet. Honestly, most of their everything is driven mostly from their reserves and capital, very low debt. They do have debt from about 200 odd crores. If you look at the balance sheet over here, it's easier for you guys to see. So they do have a debt about 200 odd crores, but it is very easily offset by the kind of investments and cash that they have. So company is pretty much net debt free if you were to look at it from that point of view. They also have had a higher trade receivables, and this is again very recently. The key reason that the company has highlighted this is because they actually acquired Kandla Energy this year and in Jan, and by the time they got this on their books is basically end of March, which is where a lot of their receivables were also passed on to them. In addition to that, Deep Industries actually raised invoices for the PEC contract that they did with ONGC. And so typically it takes about 90 to 120 days for those for that money to come in also. So it's showing on receivables, but they've assured the investors that in the next cycle, when this refreshes, this receivables is going to significantly come down. That's that. In terms of the cash flows, company has had healthy cash flows. They're positive in terms of the operating cash flows. They've also been investing activities in terms of the fixed asset purchases. So they have been doing their capital allocation. And even if you look at the CFO to PAT, it is reasonably healthy. I did that quick calculation earlier. So if I look at the cash flows, so yeah, it comes out to about 1.1%. So 110% of CFO is to PAT ratio that the company is having. So I think it's pretty healthy as well for the last 3 years at least. So let's just jump on to the valuations. I actually did the valuation sheet. Let me just open that very quickly. 1 second. I think I just closed it. Just 1 second. Yeah, I'm just going to first talk about the base scenario. I hope this is visible. Let me just zoom in if it is not. So the way I've assumed is currently FY25, the company is doing around 576 odd crores of revenue, and the management is saying that on a conservative level they should be growing at about 25%. Now, one thing that we need to be aware of is that I did do a quick dip check on whether management walks the talk, and it has been a make or a break kind of a thing. There have been times where they have gone past what they have guided for, and there have been times where they couldn't meet their guidance. It's a 50-50 case scenario. So we will go by the lower conservative part of it. They've said that 25% should be very conservative and they should be able to reach. So let's just go by 25% growth. And even from an operation OPM percentage in 2025, there was around 40%, and management has said it's going to be between 41 to 44. But I've just assumed on a lower end of the spectrum to be on the conservative side, right? So that's where it is looking at, and this is how you look at the revenues growing. It is expected to be around 1100 odd crores in about 2028, FY 2028. And then this also translate into an EBITDA of about 295 to 428 crores between the same period. Then if we look at the interest costs, it's not expected to rise significantly because the company is already net debt free, but still I've assumed that it still goes higher because they need to fix their Kandla energy plant, and there's going to be some sort of a regular capex every year that they'll be doing for their maintenance of the existing assets, and then also depreciation for the new assets that they've purchased. I've just assumed slightly that it'll gradually increase slightly. It's not expected to go further. And then if we assume it, if we look at the nominal tax of about 26% on average, what the company pays, actually company has been paying lower than that, but I've just assumed on a conservative basis, it's going to be slightly higher. It all translates to, and I've also given a PE of about 20 to 22. Now, company is currently operating at a PE of about 19%, sorry, 19 times. And I've assumed that the PE should be around 22. This is again on a very conservative level. I feel like a company that is guiding for about 25 to 30% growth with the kind of margins that they have, the PE should be slightly higher than that, in my opinion. It's only fair. But even in a base case scenario, we're just saying that the company actually goes ahead with the same kind of a PE. Then we are looking at a CAGR for 3 years of about 19 odd crores, sorry, 19% on a base case. And obviously, bear case, I've reduced this slightly. I've reduced the growth from 25% to 22%, again, going conservative. And operating margins also I've reduced from the company saying 41 to 44%, but I've gone with 35%. And the PE is also reduced to about 18. Even then, the company has some sort of a upside left, in my opinion. And if you were to look at the bull case, going by what actually I've not even assumed even here where what the company is going to, what the management is saying. This could actually even be higher, but even in a, sorry, bull case, yeah. So here I've actually assumed what the company is guiding for. So the company is saying 30% margins and about, sorry, 30% growth and about 40 or 42, 43% margins. And PE I've just given not too high. It's only a fair valuation in my opinion. But even then, we see a CAGR of about 31%. Now, I feel like the valuation should be somewhere in between. If we were to look at the returns, in my opinion, it would fall somewhere between the base and the bull scenario. That's from the valuation point of view. I think we've covered pretty much everything here. Just the risks are left. Let me just scroll down. So yeah, what are the risks involved? So one is obviously there's a regulatory and policy overhang. While the government is guiding for, there is a policy tailwind for the company, but if these don't translate into a revenue or more potential contracts, this could be a risk. Obviously, commodity prices, forex volatility. Again, many of these actually, like if you look at Prabha Bar, it is on a dollar linked kind of an OPEX model that they operate in. And if there's a forex volatility, obviously their revenues can dip from there. Customer concentration is a big risk. But then again, I think it's very normal for an industry like this where ONGC has about 50-60% share of all the oils and wells that they are, or the exploration which is going on. So there are not too many players in this space. So you have got to play with whoever is there. So about top three PSUs actually drive about 70% of the backlog. So risk in that sense is that if anything happens with any one partnership, this could affect their revenues going forward very significantly. Obviously, there are accident risks, safety risks also involved. I don't need to stress about that. And I mentioned about the contingent liability and the legal case that ONGC and Deep Industries were involved. Basically, the ONGC officials were accused of a scam that they took some bribe from Deep Industries, and basically they did their own investigation. They said that you guys provided a very old kind of a machinery while you build us for a new one. And long story short, this has worked out in a manner that it's currently in the Supreme Court. And what the company has said that the revenue, not the revenue, rather the award money that will come out from this kind of a case is up to the tune of about 100 odd crores. And they are not sure exactly when this was going to happen, but this could happen anytime because their case is pretty strong. They have already won the case in the lower courts and even in Supreme Court. As of now, the way it's progressing, at least the management believes that they have a very strong chance of winning it. Yeah, I think on a very high level, I think you guys can do your own technical analysis. I think this will give you a good perspective of the overall business. I see that pretty much right now there has been some bit of a spurt. There was a drop in the overall share price, and I think this is an opportunity just because of the market altogether. And yeah, I'm not going to go too detailed into technical analysis for here.